Welcome to the Interest Rate Academy. Class is now in session. Today's topic is U.S. Treasury Securities. Let's get started. Good day, and welcome to this tutorial. United States Treasuries are fixed income securities issued by the U.S. Department of the Treasury to raise funds for government spending. They are considered one of the safest investments in the world because they are backed by the full faith and credit of the U.S. government. As a result, their yield is often referred to as the risk-free rate. Treasury securities are classified into three categories based on their maturity. The first category is known as Treasury bills. Treasury bills have maturities of 1 year or less. The next category is Treasury notes. Treasury notes maturities range from 1 to 10 years. And the final category is Treasury bonds. Treasury bonds have maturities of greater than 10 years. The primary method through which Treasury securities are sold is via public auctions. These auctions are an essential part of the government's debt issuance process, providing a transparent and competitive mechanism for market participants to acquire Treasury securities. After the initial auction, U.S. Treasury securities continue to trade in the secondary market, which is where existing owners can buy or sell these securities among themselves. The secondary market for Treasury securities is highly liquid and plays a crucial role in providing ongoing price discovery, liquidity, and opportunities for investors to adjust their portfolios. Prices of Treasury securities in the secondary market are determined by market forces, reflecting changes in interest rates, economic conditions, and investor sentiment. The yields on Treasury securities are inversely related to their prices. As yields change in the market, the prices of existing Treasury securities adjust accordingly. Treasury bonds are considered the risk-free rate. This is because they are assumed to have a very low probability of default. Their interest rates on these bonds are used as a benchmark for other fixed income securities. An important fact to be aware of: even though Treasury bonds represent a very low probability of losing your principal investment, they are subject to price fluctuations based on moves in the interest rate markets. Remember from our previous tutorials that when interest rates fall, the price of Treasury securities will rise. Conversely, when interest rates rise, the price of Treasury securities will fall. This is known as interest rate risk. Now let's look at reinvestment risk. Reinvestment risk is another aspect of interest rate risk. It refers to the risk that future cash flows, such as coupon payments and principal repayment, may need to be reinvested at lower interest rates. If an investor receives fixed coupon payments from a Treasury bond and interest rates decline, reinvesting those payments at the new, lower rates may result in lower overall returns. An important concept in fixed income investing is duration. Duration is a measure of a bond's sensitivity to changes in interest rates. The higher the duration, the more sensitive the bond's price is to interest rate movements. Treasury bonds, especially those with longer maturities, tend to have higher durations. This means they are more susceptible to changes in interest rates, and their prices can experience larger fluctuations than shorter-term bonds with lower durations. We will do a deeper dive into duration and bond pricing in future presentations. The important concept to take away from this tutorial is that longer-term bonds have higher durations, which makes their prices more sensitive to interest rate moves. The United States has the largest bond market globally, with Treasury securities making up a substantial portion. The U.S. Treasury market is considered a safe haven for fixed income investors worldwide. Some of the largest buyers of U.S. Treasury securities are corporations, retirement accounts, pensions, hedge funds, foreign governments, and even individual investors. Additionally, U.S. Treasury securities are considered a safe haven worldwide, and they are often used as a form of reserve asset by foreign governments. Treasuries can experience greater demand in times of crisis, such as war or financial turmoil. I hope you enjoyed this tutorial. Thanks for joining us today. Remember, the more you learn about interest rates and other financial markets, the better you'll be at navigating the complex world of money and investing. Until next time, don't forget to hit that like button and subscribe to stay updated with the latest in finance. Feel free to share this video with anyone you feel would find it informative. The Interest Rate Academy is produced by Chuck Borjoli. a 30-year veteran of the credit and interest rate markets. Have a great day.